Welcome back to the deep dive. Today we are analyzing a subject that has, well, it's jumped from the fringes of crypto to the absolute center of global finance.
Right.
Stablecoins for payments. You see the massive transaction volumes. You hear all the debate over regulation.
It's everywhere.
It is. But what we want to understand is the practical global landscape. How this technology is actually replacing traditional money movement.
Our mission today is really to deliver a shortcut to being well-informed on this. And before we start mapping out, the geography of adoption, maybe let's just nail down the core concept.
Good idea.
We're talking about stablecoins. These are digital tokens designed specifically to maintain a stable value.
Unlike volatile assets like Bitcoin, the whole point here is stability, right? But
Yeah.
how? How do they actually achieve that?
So they achieve it by being pegged, usually to a fiat currency like the US dollar. And that peg is maintained because the token is backed by high-quality liquid assets.
We're talking about things like cash or...
Cash, short-term U.S. treasuries, things like that. Yeah,
Okay.
very stable reserves. And this stability is the key. It allows the coin to function as reliable money, a medium of exchange and a settlement instrument.
Okay, so the core value proposition here, this is where the excitement is. Stablecoins promise payment solutions that are faster, cheaper, highly programmable, and this is the big one, they operate outside the traditional banking rails.
Exactly.
It's an infrastructure play. And the genius of it isn't just speed, but the ability to move value across borders without, relying on all these lawyers and legacy rules.
That's a great way to put it. The movement of value on these new rails is just fundamentally different, which leads us to the engine room of this whole technology.
So if the traditional banking system is like a freight train, it's slow, it's reliable, but it only runs during business hours, how do these new rails actually move the cash?
It's all about tokenization and distributed ledger technology. I mean, stablecoin transfers happen directly on blockchains.
So peer-to-peer.
Peer-to-peer. Value moves directly, the confirmation is almost instant, and the system is on 24/7. That always-on immediacy.
Yeah.
That's the foundational shift.
Yeah, if you've ever had to wait 3 to 5 business days for an international wire to clear, you feel the pain this technology is trying to fix.
Oh, absolutely.
Yeah.
Those old payments rely on, batch processing correspondent banking networks.
It's a multi-day dance built for the 1980s.
It really is. Stablecoins just bypass all of this. What takes days through that correspondent banking chain, it takes moments on a public ledger.
But doesn't using a public ledger for something as crucial as payments raise some security concerns compared to the closed, super secure bank systems?
It raises different concerns, for sure. The main ones are around the reserve backing and the issuer's regulation. But the cryptographic security of the ledger itself is often incredibly robust. And actually, the transparency who sent what, when, is often way higher than in those old closed systems.
Okay, here's where it gets really interesting for me, beyond just speed. We talk a lot about the technology being programmable. For anyone listening, why does programmable money even matter for a standard business payment?
Programmability is it's revolutionary because it moves beyond a simple transfer. Think of enabling conditional transactions, what we call smart contracts.
Okay, so like an automated escrow.
Exactly.
Yep.
A business can set up a payment that automatically releases funds to a supplier the moment a milestone is met, confirmed by an external data feed or even a delivery confirmation. It just takes human intervention and the costs and delays completely out of the loop.
It just cuts out the middleman and all that friction, moving global funds at low cost with transparency, no time zones. That's the core promise.
And that promise has led to some dramatically different adoption paths across the globe. It's really a tale of two systems when you look at it.
Let's start with the one that's dominating right now. The U.S. Platforms like USDC and USDT have seen just explosive growth in the West.
The U.S. market has quickly made stablecoins a key tool for institutional settlement, especially in crypto trading. But now we're seeing it more and more for corporate treasury management and cross-border transfers.
And USDC seems particularly popular for that. Why?
Well, with USDC, the issuers commit to backing the coins with very high-quality reserves, mostly short-term U.S. treasuries. This offers businesses a reliable, digital, and globally mobile version of the U.S. dollar.
So it's essentially a digital dollar you can send anywhere instantly 204/7. And this has gone way beyond just the crypto world. The sources we looked at highlight U.S. merchants, e-commerce, gaming are starting to accept them. Why would a big online store choose this over Visa?
The biggest driver, even more than faster settlement, is the huge reduction in chargeback risk.
Ah.
When a customer pays with a credit card and disputes the charge, The merchant often loses the money and pays a penalty. Stablecoin transactions are final. They're irreversible once confirmed.
So that entire systemic risk just vanishes. That saves businesses real money.
And it cuts down on a ton of operational overhead for their finance teams.
Of course, the regulators have woken up to this. In the U.S., the whole discussion is now about making sure that stability is real, right? With strict reserve transparency, consumer protection.
And managing systemic risk as this thing scales to, trillions of dollars.
Right. Now, if we cross the globe to China, the approach could not be more different.
It's diametrically opposed. Where the U.S. lets market-issued private stablecoins flourish under, regulatory supervision, China just restricts them.
A full block on the private sector. So what's their solution?
Their solution is the digital yuan. This system also offers instant settlement, but here's the key difference. It operates under full state oversight. It's not issued by a company. It's a liability of the central bank.
Meaning every transaction is ultimately viewable and controllable by the government.
That's right.
This really highlights the central tension in this whole debate. The West is pursuing regulated, market-driven stability, while China prioritizes centralized governmental control.
But even China sees the efficiency of digital settlement for global trade. We see Chinese firms in supply chain management experimenting with blockchain-based settlement, using tokenized assets. The efficiency is just undeniable, even if their preference is always for centralized control.
So if the U.S. and China are the extremes, let's look at the countries trying to find that regulatory sweet spot. Maybe we start with Europe, specifically the UK.
The UK views stablecoins not as a threat, but as an essential piece of its long-term digital finance strategy. They're being proactive, outlining regulatory frameworks to bring payment-specific stablecoins fully into the fold.
It's a strategic move, right, to keep London competitive.
Absolutely. And you're seeing British FinTech exploring GBP-linked stablecoins for merchant payments, treasury operations. It's seen as a complement to existing services like open banking. The UK is trying to balance innovation with financial stability. It's a tough balancing act.
Okay, now contrast that with Singapore.
Singapore has taken a more established, structured path to attract global business. The Monetary Authority of Singapore, MAS, has a very clear framework. It focuses on issuer requirements, guaranteed reserve quality, clear redemption rights, and operational transparency.
So what are they using them for in a hub like that?
Primarily, it's USD-linked stablecoins used by international firms for cross-border treasury and liquidity management. Singapore's goal isn't to replace their real-time payment systems like Fast or PayNow. It's to make sure stablecoins can coexist with them, offering dual rails for high-speed, cross-currency deals.
Okay, let's move to India, which is a bit of a puzzle. India has arguably the world's most successful domestic digital payment system, UPI, but their regulators are extremely cautious about private stablecoins.
India's caution definitely limits domestic use, but global necessity kind of overrides local rules for big international businesses.
How so?
Indian tech and outsourcing firms rely heavily on stablecoins for international payments. The reason is simple. It eliminates FX friction.
Let's define that. When we say FX friction, what specific pain point are we talking about?
We're talking about the high cost and the complexity of converting one currency to another through a bank. The spread between the buy and sell rates, the hidden fees.
Right.
Stable coins, especially USD-linked ones, let an Indian tech firm get paid in reliable USD value immediately without losing a percentage to the bank spread and waiting days for it to settle.
So for them, it's a huge competitive advantage. The future path for India, though, might be something different, like tokenized bank deposits.
That's a crucial concept to understand. Tokenized bank deposits are different from stablecoins because they represent a liability of the regulated bank itself, not a separate company. They offer the speed of a digital token, but operate squarely within existing banking rules.
Okay, so if the developed economies are still figuring out these nuances, where are stablecoins solving the most pressing, immediate problems on the ground?
That takes us to regions where financial friction is, a matter of daily survival. I'm talking about Africa and Latin America. Here, stablecoins aren't just an upgrade, they are a financial lifeboat.
Let's focus on Africa first. Nigeria, Kenya, Ghana. What specific problem are they solving that mobile money platforms can't already handle?
Mobile money is fantastic for domestic transfers. But when Nigerian freelancers or small businesses export services globally, they hit a wall.
The wall of traditional banking.
Exactly. They face huge FX spreads, the local bank takes a big cut to convert the currency, and settlement can be glacially slow. Stablecoins just bypass this. A Kenyan software developer can be paid in USDC instantly, hold that stable USD value, and convert it locally when the rate is best for them.
So they act as the cross-border layer that complements the mobile money infrastructure that's already there.
Precisely. And in Latin America, Argentina, Brazil, Mexico, the driver is volatility. When your local currency has high, unpredictable inflation, stablecoins offer an essential alternative store of value. People in Argentina aren't just using them for transactions. They're using them to hedge against currency risk and preserve their savings.
That real-world utility is a powerful argument for the platform's viability, and it's fueling massive investment, which brings us to the business models. How are these platforms actually making money?
Well, the initial revenue stream is pretty straightforward.
Yeah.
Transactional activity. Fees from conversion, withdrawal, on-chain stuff. But increasingly, they profit from the reserves themselves.
How's that work?
Those high-quality assets backing the stablecoins, like U.S. Treasuries, they generate interest.
All right.
And the issuers get to keep that yield.
So managing the reserves is a major source of profit itself. And then there are value-added services like wallets and merchant tools.
Exactly. Looking ahead, the whole ecosystem is clarifying itself pretty quickly. Future growth is all going to depend on regulatory clarity, interoperability, and integration with mainstream finance. We're going to see a multi-layered environment emerge.
You mentioned tokenized bank deposits earlier. So if we have regulated stablecoins and tokenized deposits, and we know central banks are working on CBDCs, what does that multi-layered future actually look like?
It looks like coexistence. Different forms of digital value will serve different needs. CBDCs will offer the highest level of state assurance, but probably less cross-border use. Tokenized bank deposits will offer speed but stay inside the existing bank structure. And regulated stablecoins will offer that guaranteed 24/7 global interoperability.
So businesses will have to choose the right tool for the job. Do they need the stability of a central bank or the global speed of a stablecoin?
Exactly. The choice will depend on their geography and their compliance needs.
So to synthesize all this, stablecoins really combine the stability of fiat currency with the speed and programmability of blockchain. And the global examples we've covered, from the inflation hedge in Argentina to the regulatory embrace in Singapore, they show this huge potential to fix cross-border payments and cut settlement friction everywhere.
It's a fundamental change in how value moves. But let's leave you with the question that really connects all these global developments.
Yeah.
We saw that huge difference between China's focus on control and the West's preference for regulated but decentralized stablecoins. That tension defines the future.
So what does this all boil down to for the user,
Yeah.
for the business?
Given this growing global preference for either centrally controlled digital currency or highly regulated market-issued stablecoins, what will be the ultimate criteria that businesses and consumers prioritize when they choose the next generation of digital payments? Will it be full governmental oversight and the promise of ultimate stability, or will it be guaranteed 24/7 global interoperability and speed? That choice, when it scales up, is what will define who wins the global digital payment race.